What's going on, everyone? Welcome to another episode of The Remote Real Estate Investor. I'm Michael Albom, and today with me I have Krystle Moore and Kenny Simpson, a real estate power couple in the lending space. Kenny in the residential side and Krystle on the commercial side. And they're going to be talking to us today about things that we need to know about each space, what we can do as borrowers to be well equipped, as well as things to look out for as we're purchasing each type of property. So let's get into it. Hey everyone, just a quick shout out before we get into the episode. Definitely want to encourage everyone to go check out roofstockacademy.com. It is a one-stop education shop for both new and seasoned investors. Comes with tons of access to on-demand lectures, potentially one-on-one coaching with me or some of the other coaches we have at the Academy, as well as marketplace cashback credits for you to use on the Roofstock Marketplace as you're making a purchase. So come check us out, roofstockacademy.com. I look forward to seeing you in there. Krystle and Kenny, what is going on? Thanks so much for taking the time to hang out with me today. I appreciate you.
Thanks so much for having us.
Yeah, thank you. Excited to be here.
Oh my gosh, I'm super excited. We are going to be chatting today about all things real estate financing related. So give us a quick and dirty insight into the two of you, who you are, where you both come from, and what is it you're doing in real estate today?
Sure. Who we are? Well, people for short, if you want to cheat, they call us K and K because we both have K's in our name. So our background is in financing, commercial for Krystle, residential for Kenny. We've been doing it for about 18 years here in San Diego. And we invest as well too, primarily in multifamily. Gosh, how did we get here? Basically just jumped into the business and then kind of built our business up. And then at some point in our career, we decided to get real crazy and start a property management company. And that grew way too big, way too fast. And we said, how are we going to ever have kids and a life and do anything else? Because we can't work 80, 100-hour weeks. So we sold the company to a startup and kind of took that time, continued to work on building our brand, starting our podcast, doing a lot of content, while doing our main businesses, the finance and we just are active investors. So that's kind of the short story.
Right on. So you both kind of tag team in the residential side of lending and then also the commercial side, but it sounds like you're investing mostly on the commercial side.
Yeah. So we invest primarily in multifamily. And I think, they kind of call us the one-stop shop in terms of financing, just because there's a lot of crossover between the residential and the commercial. And Kenny's gotten really experienced at dealing with complicated real estate investors and people who own, several properties. I mean, things like we always say that those clients are like an underwriter's nightmare, but Kenny knows how to walk them through the income and how to do all that kind of stuff. And then a lot of times they want to cross over into buying apartments. So it's a good partnership for us and it works out well for our clients. Perfect.
And I feel like so many of our listeners as well kind of go through the single family organic progression, start with single family, then maybe a duplex, triplex, quad up and therefore. So where have you seen from your experiences, like people do really well in the commercial space as opposed to sticking in the residential space, that 1 to 4 unit? Like when's the appropriate time for someone to graduate, if you will, or make that leap from 1 to 4 into 5+?
Honestly, I mean, at least for us in Southern California or probably any major metro, your biggest issue is going to be qualifying for the loan amount. So I think when you're trying to make that transition from residential to commercial, people come to me and they say, well, what LTV can I get? And I'm like, well, I need to underwrite the property because it's not like that. Just because we can go to 75 or even 80% LTV, it doesn't mean that the property is going to qualify. So in San Diego, at least, or Southern California where we're at, we're usually debt service constrained, so cash flow. And I like to tell people the lower the cap rate, the bigger the down payment. So obviously cap rates have been super compressed recently. And then now with rates going up, that means people are having to put more money down. So the best time to make that transition is when you have the cash to make it. I tell people I always recommend the more units you can buy, the better. Because, if you have a 4-unit building and one person vacates, you have a 25% vacancy. Maybe you'll break even on that property. But if you have a 10-unit building and one person vacates, you have 90% occupancy still. So you're likely still cash flowing even with one person vacating. So you really want to get to that point, but you might have to the BRRR method or those kinds of things to trade up. But the biggest thing is just making sure you have the down payment. I think people should always be underwriting because that transition from 4 units, let's say, to like a 5 or a 6 unit building, you've got to kind of like look at 4 to 6 units just to make sure that you can get the down payment before you take that step.
Okay, that makes a ton of sense. And let's maybe even take a step back for anyone that's not familiar with either the lending space as a whole or what commercial financing is. So I'd love to hear from both your perspectives. What do you look for on the residential side? Like what pieces of information are you looking for? And then on the commercial side, because I think it's a little bit different, what pieces of information are you looking for and how do you treat those two different types of loans?
Yeah. So the residential, I don't want to say it's very straightforward because we have more options than probably Krystle. And the reason why is because with Krystle, like she says, if you just do not have the down payment, then you might just not qualify. With us, the property could like not cash flow and you could put 25% down and still, if you qualify with your income, you could still get it. But we also have full doc programs, maybe bank statement or debt covered service ratio programs. So we have multiple. So really what we're looking for probably is depending on if you're buying a 4 unit, most of the time you're going to be looking at least 25% down. Like I said, the property does not necessarily have to cash flow. On a DSCR program, that might be a little different. But we have people buying, like example, a 4 unit. It's way under rented. They're going to buy it. They're going to kick people out and they're going to raise the rent and it's going to eventually cash flow. So that's number one. Obviously, number two, you're looking at credit. Can you go full doc and kind of the traditional stuff of everything else? So, but when you're looking at a 2 to 4 unit property as an investment, you're definitely going to have to put like at least 25% down. And some people are putting more because rates are higher and they just want to make sure if they buy it that it's cash flowing too. So that's probably like the general quick like overview with 1 to 4, like 2 to 4, for example, on investments.
Okay.
I think that's the issue. Like for me, when I talk to people who are buying 4 unit properties, the biggest thing I want to make sure of is, like Kenny said, a residential lender will give you a loan even if the property is cash flow negative. But the purpose of buying investment properties is to be cash flow positive.
Yeah,
so,
right.
You kind of have to do more of your own due diligence up front when you're buying a 4 unit versus apartments. I mean, I like to say like a bank's never going to let you really fail because they're not going to give you like a loan that's higher than what the property can support. And they're going to put a lot of like cushion in there too. We have replacement reserves. If you're self-managing, we're still going to use a management fee. We use a vacancy factor. We have all these kinds of things to kind of set you up for success as an owner. I always say like with apartments, you basically have to ignore your property and not pay attention to it and completely neglect it in order to run it in the ground. Like apartments are very forgiving. So when it comes to the 4 unit space, I tell people like you should be underwriting your 4 unit just like you underwrite an apartment building because probably the agent's not going to do that. I think that there's a little bit of a hole in the realtor space where, people that sell homes are also selling 2 to 4 unit investment properties, but they don't even know how to underwrite an investment property. So you just want to make sure of that and underwrite it like an investor. Like I always tell people, marketing is marketing, right? So you want to look at it as an investment through an investor's eyes. What's that really going to cost you? Not the pretty package. If everything goes 100% perfect, you want to like kind of factor in, additional expenses that are unforeseen because these are properties, and especially in Southern California, you've got a lot of older properties. So you're probably dealing with plumbing or electrical. You're going to have more maintenance than what's probably in the marketing package.
So is it fair to surmise for a residential, you're more interested in the borrower itself, and on the commercial side, you're more interested in the property itself?
Yes. So we're definitely more interested in the property, but people say that to me. They'll call me and they'll go like, it doesn't matter about what I have. It just matters about the property. Well, no, we also want to make sure that you have decent credit. We look at what we call global debt service. So we are going to make sure that you can afford your monthly bills and things like that. So you definitely need to qualify, but it's not as strongly looked at as you would on residential. Like for example, if I'm going to do a commercial loan and I'm getting copies of your bank statements, I'm not going to ask you to source your $1,000 cash deposit and, like all these things.
It's so real.
Like painful.
Yeah.
Painful. So I like to say that we have common sense. So we allow, cash from business accounts. We allow personal accounts. We're not going to question you about all these things. So yes, we're a little bit more easygoing because we look at you as a sophisticated business investor. You're coming to me for a business loan. That means you're a savvy investor, not an unknowing, potential homeowner. So we do look at it a little bit differently. You do need to qualify personally, but we do put most of the weight on the property.
And you do, but you guys do require, like, if you are getting into bigger loan amounts, like some people like, hey, I want to go out and buy this 30 unit building, and there is a net worth requirement, stuff like that. So
Yes.
the bigger you go with the buildings and the loan amounts, I would say it's like they're going to look at you not just like, net worth, but probably like a lot of different, like talk about that. Like if
So-
somebody is going for a bigger building, I feel like they're going to look at you a little bit more.
These
though.
are the big things that you need to pay attention to. Because if you go to a commercial lender or you want to buy an apartment building, they're not going to give you a pre-approval. They're not going to get you pre-qualified. If you ask for that, they're going to immediately know that you're a rookie and you've never done this before. So what we look at is your personal financial statement and your real estate schedule. And what we're looking at specifically is that your net worth is at least equal to or greater than the loan amount. And then we also want you to have 10 to 15% of the loan amount in post-close liquidity. So that means after your down payment, after paying all your closing costs. So let's say you're going to get $1 million loan. We want to see that you have $100,000 to $150,000 of cash or cash equivalents. Most of the time, retirement doesn't work. That's not going to, unless you're close to the age of being able to access it. Okay. So, and then credit score, it's like, we're kind of like 680 score. I mean, some big owners have like things on their credit. So, that are like maybe a tenant eviction or like, they've got little things on their credit. So we're not really paying attention to that. As long as you look, you're credit worthy, you don't have a bunch of mortgage late and you didn't file bankruptcy last year, like those are the kinds of things that we're looking for. But net worth and liquidity are the two big things that we require.
Are they looking for experience too at a certain level?
They do want you to have experience. But if you don't, then they want you to hire a professional property manager.
Okay. And yeah, Kenny, you took the words right out of my mouth. So when you do send, because that's like, I've got a mortgage package that I send all the commercial lenders. That's got my PFS, my scheduled real estate. But for anyone that's just getting started, like if they want to go buy a 5-unit building as their first one, is that going to be an obstacle for them from a lending perspective?
Not typically. They'll more than likely want you to have a professional property manager. That's what most lenders are looking for. And quite frankly, though, I've been telling my lenders this more recently, and I feel like, believe it or not, of all the things, especially with where we're at in the world and everything in the economy, that I feel like lenders have let up on is the experience. Because I tell my lenders, it's really funny that anybody can go buy a 2 to 4 unit property. And again, negative cash flow. Here you go. Here's a loan. You're going to be negative $1,000 a month. But now you want somebody to have all this experience for apartments. Like if you can survive owning 2 to 4 unit properties as an investor, then you can definitely own 5+ units. I think that's sufficient experience. So we've been getting around that. But some lenders are still going to want it. I still definitely stand by my argument, though, that if you can own a 4 unit, that you can definitely own a 10 unit. It's not like you're going to go from 4 to 400. If you go from 4 to 6 or 7 or 10 units, that's pretty comparable. But some lenders might require a signed property management agreement. Okay.
And from both your experiences on the owning and operational side of things, I mean, what are some of the big differences that you see? Obviously, we talked about lending, but like just between like a 2 to 4 and then a 5+, like what are the differences that people should be aware of?
Yeah. So 2 to 4, well, one of the things is, especially here in San Diego, a lot of people on the 4 units, they're moving into them, right? So you could have an owner user. If it's not an investment, you could live in it and you have the tenants there helping to pay your mortgage. The other thing is on 4 units, a lot of times the trash might come with the property tax. You don't have to have a dumpster on the property and paying that additional. A lot of times the tenants are paying their own water, electricity, and things like that. So the cost of running it could be cheaper just from that standpoint. And then otherwise, like the 4 unit, I mean, if you're managing it, you're going to manage it pretty much the same. I mean, Krystle can kind of get in when you're getting bigger, but when you're getting bigger, 5 to 15 or 16, probably the same. When you get over 16, the difference really is you're going to have that on-site manager by law. But then, as you get bigger and bigger, if you got 100 unit, then you're going to have staff and this. So it's really like Krystle says, as you scale in size, it makes more sense because, if you have 100 homes compared to 100 unit property, it's a lot more work, 100 homes driving around, 100 roofs, 100 things like that. So, I don't know what else you'd have on the larger scale.
Yeah, I would say the management of like a 4 unit to like a 15 unit building is roughly the same, besides the fact that you have economies of scale. Like Kenny mentioned, it's like you have all these roofs to take care of, all these walls to take care of, things like that are going to be, cut down if the larger the building is. So, and then once you get 16+, you have the on-site manager. But honestly, I think the psyche of the person that owns a 4-unit is the biggest difference. Cause like I said, I mean, it's stressful. You bought this property as an investment, you saved a bunch of money for it. If you have to come out of pocket for that investment, that's an extra expense that you didn't anticipate if you have vacancy or if, you got to evict someone or things like that. So what I've noticed is that the real estate investors who own like the single family home to the 4-unit have a lot more stress when they have vacancy or someone that doesn't pay because they're going to be negative. Whenever you own a larger apartment building, you have a little bit more comfort because you have a little bit more margin for error there. So I think the biggest thing is just the psyche of the person that owns the 4-unit versus owning the larger building. And of course, there's like this kind of breakthrough transition that you have to have the confidence to make that step. But I tell people it's 100% going to be easier the more units you own. Like you're just going to feel more safe, more confident. You're going to have the cash flow, no worries. You're not going to be negative. You're not going to be putting money into your investment property.
Yeah, and when we managed from homes to at one point I think it was over 100 units. The single families would do great until somebody wouldn't pay rent or they'd move out and they have to do a unit turnover and it costs more than the deposit. And then it would sit there for maybe a month or two sometimes because they're trying to get this high rent and they didn't listen and couldn't get it. And you're losing money. And the other thing is we know guys that like flip properties, for example, like they flip houses and then you come to an environment like now where it's sitting maybe, could sit 30, 60, 90 days. They're getting zero cash flow. And then when the guys started saying, well, I could just flip apartment buildings and maybe they're going to even hold them for a year or two in exchange, they started realizing why I'm sitting here on the market. I'm actually making money. I'm getting paid. I'm not sitting there going, I need to get this off my books. It's cost me money, the private money. So there's, like the bigger, the better. So when we manage it all, we realize like, if you really own a house, it's like, man, it's almost has to be free and clear to like really make sense. Otherwise, we always thought like, gosh, it's tough, So that's just from our experience here, just managing it. And then on the bigger it went, you're more like when you do those little rent raises, you're like, yeah, but a small rent raise across 30, 40, 50, 100 units, that adds up. You don't think so. You're like, oh, $100 a month times 100. Holy crap. That's a lot of money,
10 grand.
Yeah. 10 grand. So
Totally. Okay. That makes a lot of sense. And Krystle, you mentioned it before, but I just want to come back to it from the underwriting perspective. What do you do with seller provided pro formas? Do you think there's any value in those?
Totally. I primarily just pay attention to like utility cost and like trash and stuff like that. So I pay attention to like the things that aren't going to change for a new owner. And I pad those even a little bit because obviously utility costs have been rising. So those are the biggest things that I pay attention to. And then I also want to look at, like I usually ask for the GL, like the general ledger from a seller too, because I want to see what repairs they've been making. And look for any kind of patterns. Okay, this property has a lot of plumbing issues. Like we need to focus in on that. Maybe we look at replumbing. Maybe we need to get the camera the lines. Like we need to look at this. What CapEx have they done? Like I want to know what kind of capital improvements they've done on the property so I can kind of get an idea of what the condition is. So I definitely do pay attention to the sellers' pro formas, but I build my own. And they usually, like for example, brokers here will use like a 3% vacancy factor. I use 5.
Right.
Lenders use 5. They'll use like $200 a unit for replacement reserves. We use $250 or even $300. So there's just little things like that where I'm going to be more conservative, but certainly actuals are very, very helpful. So if nothing else for the utility cost.
Yep. No, I was hoping you would say something to that effect. I always say that they're good. They're good for lining your garbage can. So pro formas.
Pretty much.
It's like, in place rent $400, market rent $1,200. It's like, then you get it to $1,200.
Yeah.
Yes. And you know what? I've seen it both ways. I've seen it where sellers are underestimating what the building's worth. So that's why it's so important for you to do your due diligence because they can be too aggressive. They can not be aggressive enough. I mean, the whole like value in finding real estate as an investor is where if you can find value where other people aren't. Like I've heard so many people say, LoopNet is the worst place to find apartments. Well, I found really good deals on there because I was able to look at it in a way that nobody else did. I was able to see value in, creating additional income or reducing expenses. Like there's deals everywhere to be had. It's just, are you going to do the work and investigation to find where the little like pops of income and value adds are?
Krystle didn't mean it. LoopNet is a terrible place. No one should go on it, look at it ever. We should all stay off it.
All right.
No.
Hey, I'll get more deals.
That's exactly it. Like, I love that it has that stigma because I think it does turn a lot of people off. And I like you, have found some amazing deals from there. So it's like, awesome. Keep thinking that. It's like surfing sucks. Don't start. I let people think that too.
There's enough people in the water. Right?
Yeah. We're good.
That's it. So from a borrower perspective, and this is, I kind of want to give you to the soapbox and the podium to sing it from the rooftops. What are some things that borrowers can do to be better borrowers, both on the residential side and on the commercial side? Like, if you could describe your wish list, your ideal borrower, what things do they have? And what does their picture look like, so to speak?
It's kind of funny because I'm forbidden to even work on my own loans because I'm not a good borrower.
Really?
Yeah. And it's like funny, right? I'm not a good borrower. I'm impatient, but I will tell you, it's very simple. If somebody sends you a list of 10 things and you actually have those 10 things, we actually need them. Not like it's 9 out of 10,
but
just
maybe
10 out of 10. Yeah. So I joke, but I always tell borrowers this. I said, I'm like your doctor and your attorney. They're like, huh? I said, so if you lie to me, I can't discover the cancer. And eventually we'll probably find the cancer, but it will be like when we're 3 weeks in underwriting and somebody pulls some report and something pops up and they go, what's this? You're like, oh, I didn't think you'd find that. So I'm like, whatever you think we're not going to find, just tell me now. And so I can tell you, let's deal with it now and not 3 weeks down the road. So, filling out a full application, letting us know if there's anything else we should know going on with income, with job changing, with changing bank accounts, with maybe recently purchased property that you just aren't going to tell us that you think we're not going to find. The skeletons in the closet, right? Especially for us, because that's really what they're doing. They want to give you a loan, but they also need to go like, what is it that you're not telling us? And we pull reports, and the reports they pull, they can find things. So for me, it's just being transparent. I mean, the list is pretty easy to follow. I would say one of the things is also a lot of people think I'm self-employed or I don't really show the income or this or that and I can't get a loan. That's really not true. There's many alternative solutions for self-employed. There's solutions for people that might just have, I'm property rich. I've got some cash in the bank and I've got equity. There's options. So don't think because you're not this cookie cutter person, there's not an option. You should talk to somebody and, explore it and see it and really beat a dead horse and really make sure that there isn't.
Fantastic. And what about on the commercial space?
Again, we're so much easier.
Yeah.
I just that people go like, what do I need to get qualified? I'm like, send me your personal financial statement, your real estate schedule. They're like, okay, what else do you need? I'm like, I'm pretty good. I can tell you. So I still want your tax returns and your bank statements and all of that. So I think for me, just obviously getting us stuff in a timely manner. We have those clients that take forever to send you something. And then the second they send it to you, they're like, okay, what are we doing now? Like, are you done yet? Are you closed? And you're like, I also need time. So I think just having somebody that sends you the information that you need, again, someone like Kenny said, someone that's upfront with you about things. Like the other thing that I find is like people are just so, like they don't want conflict, right? So if they're shopping you, like they don't want to tell you. And I'm like, I've lived my entire life, 18 years doing this business, competing. Like I'm aware, but you have to be upfront because if a banker finds out, if they hear the deal from me and then they hear it from 3 other people, like that doesn't look good on you as a borrower. So you want to be upfront with whoever you're working with. Hey, look, I'm getting quotes from a few other people. Okay, well, do you know who they're shopping? Because I just won't go there. Like that's fine. I don't want to screw the deal up for you. So there's little things like that where reputation in commercial is so important. And this is a small business. We all know each other. We all talk to each other. My bankers call me sometimes and go, hey, so I just saw this deal from another broker. Like, do you know who's gonna, and it's a problem because if I dissected the information, like I don't just take information and throw it at the lender. I dissect it all. I break out CapEx. I say, okay, I got my insurance quote. It's lower than what's projected here. I get a lot of things. So what I submit might be different than what the other guy's going to submit. And so I think, just making sure that you're upfront with people and what you're doing, then I can strategize with you. Like I'm not going to get upset or work on your deal any less because you're shopping me. So I think just being upfront with people is going to get you the best deal ultimately in the end.
Yeah, I will say funny to piggyback on that. I'm not even in Krystle's business, but I know they're really good at what they do. They just do it and they know what they want, the bankers. But bankers will say, like, if I'm out, they're like, oh, Krystle and Mitch are so good. I go, well, what's the alternative? They go, you wouldn't believe how many like commercial mortgage brokers just take the stuff from the seller or whatever, just send it to us and go, hey, what do you think we can do? And they're like, did you look through this? No, you do it. And you're like, that's the person that's taking your loan and getting your loan. And Krystle, that's what happens. They could submit that to the lender and the lender's like, hey, we already saw this. Like, that's not right. I know, but we can't just throw it out the window. So who takes your information, how they present it, could literally like cost you a deal at a good lender, and it has. So that's one thing too. Make sure you work with the right people.
Yeah. I mean, to that point, Kenny, what questions should people be asking of their lending professionals they're working with, and how do they spot some red flags?
Well, number one, I would say, if you're working with, like, I know Krystle or myself, because I know us, let's say you're buying an investment property. If it's your first one, we're probably going to have a, conversation up front. We're going to ask you a bunch of questions. So we're going to kind of interview you and we get your stuff. You should be leery when somebody's like, yeah, they took my stuff and I haven't really heard from them. Like, they haven't really asked me anything. I'm like, nothing. They're like, no. I'm like, so did they talk to you about the loan? No. And I'm like, so you've had it over there for 2 weeks. Did they mention rates? No. I'm like, so when I call somebody and ask them 5 questions, they can't answer one. They've been working with somebody. I'm like, what have you talked about? They're like, I don't really know. So you should feel very, very informed by the person you're working with. And you should feel like they're getting a lot out of you. And they're also, even if you're not asking me the questions, I'm kind of like telling you like the things you should know, you should be asking. Cause like, so that way, if you do shop, you're like, this conversation was way different with Kenny than them. So, and I know you're shopping. I want to be like, I'm your guy, You
want to feel like the person's like advising you. And I don't think it's super common really to find that. For me, I think a big thing that's important is if I'm working with somebody, even a broker, like if I want to go work with a broker to buy properties, they should own properties too. Like, you should be drinking the Kool-Aid. Like, you're selling it, so you should drink it too. So I think, somebody who also is an investor, because I think they're going to understand and look at things as an owner and as an investor themselves. Like, when I look at a deal, I'm looking at it as if I was buying it, as if I owned it. So a lot of our clients call us and say, what do you think about this deal? And they get our advice, and they want to get their broker's advice. So you can listen to a couple of different people, because we all have a little bit different perspective, but especially if you're getting into this, you want somebody who can kind of guide you through this and walk you through the process. So I think, if you're interviewing people or you're wanting to like work with a broker or a lender, you should ask them, hey, what's the loan process? Can you walk me through it? And how much that person says is going to be really telling. I think you want to work with somebody you like. You just have to like them as a person. And then secondly, ask them about the process and see what they say. I mean, either they're going to say something, a few short sentences, or they're actually going to walk you through and let you know what to expect. I think that's the biggest thing is for us, we're advisors, but we also need to manage expectations. And so you're going to find out real quick if that person will manage your expectations or not by, just understanding what the process is and how they answer that question.
I just want to come back and double click on what you said about liking the person. I can't tell you how many lenders I've worked with that it feels like such a combative relationship. Whenever they call, I'm like, oh God, like so-and-so is calling, like kill me now. So and versus I've worked with people that I love answering their phone calls, and I've paid more in rate because I like them and because it was a partnering relationship as opposed to this, you versus me type of thing. So I think that that's huge.
For sure. I mean, it's somebody you're going to be working with a lot, and like, this is like getting like a physical, like strip down, look at your financial.
Full cavity search.
Yeah, all of it. So you definitely want to like that person, and you want to have like a sense of trust. And I think we only trust people we like, so if you don't really like someone, or they're not getting back to you, or they're not really communicating, you're going to have like these like, you're going to feel really insecure the whole process. And I mean, even as people who do loans, like Kenny says, I'm a bad borrower. Like, yeah, he is, because he's always like micromanaging the situation and like, freaking out that there's like some weird thing that's going to pop up out of nowhere. So it's like, you want somebody to kind of walk you through that process and manage it. If people who do loans for a living are already stressed out getting loans, like we can guarantee that borrowers who don't do this for a living are probably having a lot of insecurity.
Yeah. And one more thing I'll say is, this is good to know, is like, I'll get a complicated real estate investor with a lot of stuff. There are certain lenders you go to, and there's certain lenders you do not go to. And the problem is they're like, I was at this lender or that. And I get a lot of people that like, I went down the road with this guy and couldn't get it done. How do you know you can get it done? I'm like, well, I don't know where he went, but this is definitely a doable file. But I can tell you there's a lot of lenders I wouldn't take this to. Why? I'm like, because this is just not what they want. They're not good at this. This is not what they do. And Krystle's the same way. And I think so some people that are not doing, the investment stuff that often, they just don't know that. They just throw it against the wall, hope it sticks. And they come back and say, sorry, I know you were in escrow. We're not going to get it done. We got to start over again. You're like, what? I'm supposed to close. So, like goes back to like and trust is good, but also work with somebody that just has have they closed these type of loans? Have they done many of them,
Yeah, no, that's great. Y'all, this has been super, super fun. The last thing that I want to touch on, which I'm sure is on everybody's mind, I would love for you all to get out your crystal ball and know that wasn't a play on words. Legitimately, where do you think rates are going?
So yeah, I wish we all had a crystal ball for that. I have certain clients who think the sky is falling and rates are going to be at 10% by the end of the year. And then I have other people who are like, I think, because of the amount of debt that we have, we've never had so much debt ever. Real estate inventory is still down. There's still a lack of housing. So in terms of real estate and interest rates, I think rates are going to go up a little bit more. Most of our lenders are predicting another point to a point and a half by the end of the year. But I think after that, they're going to have to start scaling back, because this last Fed rate hike definitely caused a lot of panic in the market. That was a rough week for us, just everybody calling, is everything okay? And what's happening? And lenders just raising rates multiple times a day, which does not happen in commercial. So things like that. So I definitely saw the scare. The next Fed rate hike, I think they will raise the rates again. I think we'll be looking at another 1/2 to 3/4 hike. So I think we're in a little lull right here, right now. Everybody's okay, treasuries are coming back down. I'm gonna finish my summer vacation, but the winter is going to be a cold one, I think that things are going to slow down a little bit and people are just going to wait and see what happens, and rates will be up maybe another point or so. And then I think we're going to have to start heading the other direction, because corporate debt, there's a lot of debt besides just our home loans and our apartment loans. There's all the corporate debt, there's government debt, all this stuff. And that's all tied to prime. So if the country can't pay their bills, they're going to have to keep rates low. We can't keep going like this. So that's my opinion.
There's no such thing as a cold winter in San Diego. Come on.
I know, right?
I mean, 60 degrees is cold.
Yeah, get out your parka.
Yeah. I think, like what Krystle said, piggyback off that. I think at the end of the day, we have to understand why the rates were raised. And it's simply, we've learned, it's yes, Jerome Powell, we got you loud and clear that until inflation not just stops, but we see it progressively go low and it stays there, they're going to keep doing what they only know to do I look at it this way, and I keep saying this over and over, is the more I studied this stuff, is when they want the economy to boom, they just put liquidity in. They either give it to people, they give you gas credits, they give you money, we'll pay your rent, let's lower rates, it's all, that's monetary coming in. When they want to slow it down and hit the brakes, they just pull the liquidity out. And they're pulling tons and tons and tons of liquidity out of the system. It's parked on the sidelines. They don't talk about it, but it's a massive, massive number that's sitting there. And so on top of pulling liquidity out, which actually is the bigger issue, right? They are obviously pushing rates up. So they're going to hike. And then we all know that even if they stopped hiking now and they started doing QE, we probably still have some type of recession, So we're going to have some pain. Unfortunately, the party went on too long. They spiked the punch bowl and they left it out too long, and we are going to have a massive hangover and we're all going to feel it. And then they're going to put us to pain, right? We're going to be held down. We're going to get the 2-3 wave hold down. And then the jet ski's going to come along and grab you and pull you back out. And then when they do that, they'll probably do the same type of thing. So,
lower rates.
No one knows the crystal ball, how long this is going to go. But I just tell people, you just have to listen to the Fed. And they mean business now, and when we start feeling pain, but I think like Krystle said, is I think we're already starting to hear little this and that, from people we know that owns jewelry stores or people that have, you're starting to hear things that in the last couple of months, things have slowed down, and you're starting to hear that. It's in one way, it's like not good, but in one way it's good, because if we don't slow down, they're just going to keep raising rates and we're going to have more problems. But I feel like the next hike is definitely going to do, I feel like that's going to be it. That's going to be like the nail in the coffin.
Nail, yeah.
I feel. And I think they're going to let that run. And then I think, like Krystle says, come after summer, I think a lot of people are going to be like, we're going to start pulling back. And I'm already hearing it. I'm hearing it from people were going to do the addition on their house. Now they're not. People were going to go buy this or do this. Now they're not. People, you're hearing talks of people, and it's not that they don't have the money. They're like, I should probably not do that right now. That doesn't make sense. But that's because what the Fed's doing is working. So once this all happens, of course, we'll be back to QE, lower rates. My prediction is we'd probably start seeing some lower rates definitely by like early next year, Q1, Q2, starting to see rates come down. And look, we might be shocked depending on how much pain's in the market and stuff. They might have to really like COVID really hit the hammer on them and drop rates for a small period of time. So I think a refi boom and the pent up demand that's going to come on the backside of this is going to be pretty insane. The amount of commercial guys that are big syndicators that aren't doing deals, they're just chomping at the bit. They're waiting. Where's the bottom? So everybody's sitting here going, we're kind of waiting for this recession. Where's the bottom? Where do I enter? Right. And it's just this unknown. And it's kind of weird that we're just sitting here. Usually we get blindsided by it.
Yeah. Interesting. Well, we will definitely have to have you both back on in Q1, Q2 of 23 and see how the predictions panned out.
If we were right or wrong.
Yeah. We'll either be celebrating you or nailing you both up.
But it's funny because we do month over month. I do month over month the webinar about the housing market, and in January, you couldn't find one person that we looked at or studied that they thought by Q4 of this year, the highest rate prediction was 4% of this year. We were there like the first month.
Overnight,
so everybody that thought we were going to go this fast, nobody predicted. So that's what people like, I thought this is like, we're just kind of like in this, like, they didn't think so we're just sitting here going, wow, nobody predicted this. They all thought rates would be at least a point or two lower, which is crazy.
Oops. Yeah. Okay.
Oopsie.
Yeah. Missed that one. Yeah.
Well, you two, this has been so much fun. Really, really, really informative. Thank you so much. If people want to reach out to you both directly, where's the best place for them to do that?
You can go to getinthecashflowgame.com, and that links to both Kenny and I's separate sites for financing, whether it's commercial or residential. And then we're on Instagram and all the things. So I'm Krystle Rose Moore, and he's Kenny B. Simpson.
Yep.
Those are the two best places to find us.
Appreciate you having us on. This has been fun.
Awesome. No, totally my pleasure. And definitely looking forward to chatting with you again soon.
Absolutely.
Awesome. Thanks so much.
Take care, you two. Okay, everyone, that was our episode. A big thank you to Krystle and Kenny for coming on. A lot of fun, super insightful. And especially if you're thinking about making that transition, that leap from residential 2 to 4 units up to commercial family, this was a good one to listen. Definitely keep it in your back pocket. And as they mentioned, have some of those documents at the ready, and you'll be really well prepared for getting into some of those commercial mortgages. As always, if you like the episode, please leave us a rating or a review wherever it is you get your podcasts. And we look forward to seeing you on the next one. Happy investing.